turn it around.
It's Down to Business with Jack Miller. Forget what they teach you in school. This is real life. Not Wall Street, but Main Street. A real show on what's really involved with starting and running a business, with all the ups and downs. Our guests will answer your questions and provide you with valuable information. Stay tuned and join in the conversation. Call us at 305-541-2350. Follow us on Facebook at Jack Miller Down to Business or on Twitter at HJackMiller1.
Hello, Brad. Hello, world. Thank you for sticking with us. Brad, let's talk REITs, if that's all right. One of my favorite subjects, and I know it's something you live and breathe.
That's right. And for the lay people out there, REIT stands for Real Estate Investment Trust. And take it away, Brad.
Yeah, that's...
Sure. Well, I'll give you my elevator pitch. REITs were formed over 50 years ago in an act of Congress, actually the Eisenhower administration. And the whole purpose of the law is to give the average investor the access to institutional commercial real estate across the country. And the whole premise for REITs, and really the law is predicated on the fact that REITs must pay out at least 90% of taxable income, and most pay out 100% of income, taxable income, in the form of dividends. So that's really the attraction of this asset class, is that they pay out very high dividends, and they're also very consistent and predictable at dividends, because as you know, these are commercial properties that are leased on a long-term contractual basis or short-term. It could be hotels day-to-day, or it could be advanced auto parts, or what we call triple net lease companies, which are longer-term leases. So this gives investors a very predictable and reliable income stream. So that's really the premise. Keep in mind, MLPs, master limited partnerships, BDCs, which are business development corporations, those are also high-paying dividend structures. They're much more volatile, and they also haven't been around as long, so they're not as vetted. There's not as much historical earnings histories that we can rely upon. So REITs have really grown into a pretty sizable asset class and really a major food group for investors today.
Gotcha. What makes one REIT different from another one? They're like stocks in a way that they each have different management and different industries they focus on in different sectors. But when you're evaluating REITs, how do you evaluate them? Is it just balance sheet, or how are you evaluating, looking behind the balance sheet?
Sure. Well, again, from my perspective, I really focus on the retail investor, which are people, you two on the phone, everybody listening. I don't focus as much on the institutional side. So as a result, most of the investors that I deal with that are subscribers to my newsletter or follow me on my writing platforms, they really are more focused on dividend safety. That's really the most important metric, is making sure that you're getting that dividend either monthly. A lot of REITs pay monthly, or you're getting the dividend quarterly, because a lot of investors, especially the retirees, are living off that income. A lot of the millennials are not living off the income, but they understand the power of compounding and using the dividend income like a free ATM machine to keep buying more free shares. So I think the most important metric that I look for is to look at the sustainability of that dividend. So how safe is it? How reliable is that dividend? Nobody likes dividend cuts at all. That obviously hurts the value of your investment, any company you invest in, when you see that happen. So I try to focus on researching those companies that have growing dividend streams and are very safe vehicles.
Gotcha. How much, when I'm buying a REIT, how much do you think how much weight should I put in the dividends opposed to capital appreciation? So let's say a REIT, for example, has a 5% yield and I'm getting 5% dividends. Are you evaluating, or what do you think of the spread? How much should I be looking forward to appreciate compared to the dividends?
Well, sure. Dividends are really in the commercial real estate world. We look at the return on what's the return on the capital, return on invested capital. So, what's interesting, coming from the private side, where I used to be a developer for 20 years, and I look at how that capital goes into a building and the return it generates. What's interesting with REITs is that those are essentially your dividend income is comparable to the income you get after debt service when you invest in real estate. The huge difference, though, and this is really part of the greatest value pitch for REITs, is you have liquidity. So, I may own a couple duplexes that are generating, 6% return on my investment, but they're not liquid. I may have a portfolio of REIT securities that generate 6% dividend income, and they're fully liquid. The other part of it is you have the diversification, because you got these REITs have all types of properties within their portfolio, so much more diversified, which, again, that protects your dividend stream over time. And then finally, you've got a management team in place that manages those properties. Unlike if I own those duplexes, I have to hire a management team. And so I think you've got transparency, diversification, liquidity. Those are probably the most important attributes. So when it comes to dividend, I think you've got to factor that in. Now, most of the followers today, at least in my camp, they like to see 5% dividends and higher. Now there are some low-paying dividends. For example, the multifamily or apartment space today, they're not I wouldn't consider them expensive, but they're trading at a much higher premium or multiple today. So you're seeing the dividends are much lower; they're 2 to 3%. So again, those are tougher investments for some, especially some of the retirees who really are looking for yield. But you've got to be careful not to go too high up the yield curve in what I would call a sucker yield, where you've got a stock that's too good to be true. So it may be paying 14%. And it looks like it's a great investment, but it's not sustainable. So I really tell people to really look hard at that. That's where dividend safety really is important, and that's what I do in my newsletter. I really try to help educate investors on this most important part of investing, of dividend safety.
When you're looking and you're analyzing these financial statements, and I have to tell you, I have a long background in real estate. It's the only thing I've ever done. And I think I'm fairly educated in reading these financial statements. Some of these REITs are just impossible to read the statements. There's so much buried in. But how much do you think is a conservative or good leverage amount for a REIT to have?
Well, that's a great question, and in the prior to the recession, and arguably that's what got a lot of REITs in trouble in the recession, is leverage. And so we've seen a lot of REITs have really transitioned or delevered their portfolios to a more modest, conservative capital structure. So, some of the best REITs out there that are investment grade rated, have around 30% of debt and 70% equity. That's kind of on the most conservative side. I think on average we're seeing around 40%, 40 to 42% debt to equity. In Canada, it's interesting. I don't know what it is about Canadians, but they've gone a little further down the credit curve, and most of the REITs there have around 50, in some cases 60% leverage. But they're safe too. I do cover the Canadian REIT sector as well. There's about 70 Canadian REITs. But overall, I'd say 40%. And what I will tell you is we now kind of prepare for interest rate liftoff, which is now not, as of yesterday, is not immediate after the Fed said they're holding back again. But eventually we're going to have rate rises. And what I really like about the REIT space today, most of these REITs and the management teams have really started to plan. I mean, they've been planning way ahead of time to really de-risk the portfolio and look at. I look at long-term debt versus short-term debt, fixed versus variable debt, and so if you look overall, most of the REITs today have really prepared for the eventual interest rate rise, which we're all assuming it's going to be a very modest lift-off going forward.
Gotcha. Do you like any particular sectors currently within the REIT market?
Yeah, really my favorite, and this kind of goes back to my roots. I used to build a lot of single-tenant stuff when I was developer. So I built stores for companies like Advance Auto Parts and Walgreens and CVS, and I was very successful building those. And the reason is, and I was successful selling those to investors because of these long-term leases. They're probably the closest you can get to the bond, to a bond is in the form of real estate. So I think overall they're the safest asset class. They provide a lot of diversification, and I know that space pretty well. And most of the average investors really can understand, what an auto parts store or a convenience store looks like. So I like that space. The other space probably is healthcare. Healthcare probably has the most demand today in terms of the demographics, aging population. The Affordable Care Act has really been a good catalyst for the healthcare real estate space. It basically gives the patient more opportunities to visit the doctor, and so that's going to create more income for the healthcare REIT. And so I think healthcare is very attractive. The pricing today of most healthcare REITs is very attractive. The market has really pulled back a little bit on the healthcare space, primarily due to the skilled nursing sector, which is probably the most riskiest because it has the government Medicare, Medicaid features that are associated with it. But overall, I say healthcare and the net lease space. But I'll tell you, I mean, there's some really good value in the lodging space or the hotel space. And I'm more tactical in the shopping center space. There's about 20 shopping center REITs, but there are some really good ones there too. And I look for the necessity based REITs, or those that have a large composition of grocery stores where people have to go. But overall, I mean, the good thing is in my space there's a growing list of REITs in the U.S. There's about 200 today, which is commercial equity REITs and mortgage REIT. And so it seems like every week I've got a new company that I'm looking at researching and adding to the mix. And there's all types of new sectors today, and you're seeing a lot of the companies, even a lot of retailers like Sears and Macy's and a number of others, even restaurant chains like Bob Evans, who are looking to convert to a REIT structure. So it's an exciting time to be doing this.
What do you think of, and do you follow non-traded REITs?
I do. Non-traded REITs, I do follow them. I'm not a huge fan of them. I guess my statement on that is that they're not for everybody. You really have to have, you really need to be more of what I call a more sophisticated investor. It really, obviously, non-traded REITs give you access to private real estate, so most people get into that game because they don't like the volatility of the public space. The problem is you're paying a price for that, because the biggest issues, and I've written about this extensively, is just the load or the fees that are paid for shares in those companies. So you're basically paying 15% just to get access to the business model, and then of course you don't have a guaranteed liquidity, so you don't know when those companies are going to when the shares are going to be able to create monetization for the investor. So there's still some questions, and then it's not a great space. I think there's certainly a lot more value in the public side. And as I tell investors all the time, we have what we call REIT preferred shares, which are they don't trade as volatilely as the common shares, but they do give you that coupon, which is, again, that's why they call them preferred shares. They're out in front of the common and the capital stack. So I think if an investor really just wants to be in the real estate business and doesn't care about the volatility, maybe preferreds are the way to go if you're concerned with that. But non-traded REITs are I would tell people to really be cautious with that vehicle.
I agree, and I'll tell you, one of the things I do at my company is we purchase non-traded REITs and non-traded Reg D and real estate partnerships, and typically when we buy them, they're at pretty big discounts because there's no liquidity. The people need out. And Brad, you're 100% right. They're packed in with all kinds of sales and syndication fees, and it's tough enough to make a deal profitable, let alone when you're packed in with, 10% or 15% in fees. It makes it almost impossible to do it at that point.
Well, I think next year there's some laws that are already on the books that will now force the REITs to disclose, or those that are selling those shares to disclose the fees to investors, and that's been a big problem, is just the transparency of the space, where a lot of these investors didn't realize that they were putting they're putting $1 in the deal, but only 85 cents was going into the real estate. And so now that when that's disclosed, I think that's going to have a fairly sizable impact to that industry.
I agree. Brad, can you hold on for a few minutes? We've got to take another commercial break. Then I want to talk about specifics on some REITs if you're comfortable talking about them.